Hello, so today we are going to prepare an income statement under variable and absorption costing for the year ended December 31st, 2014. So the first thing for variable costing, we need to find our revenue. So in order to find our revenue, it's going to be our selling price times our units sold. So our selling price is $23.50 per unit times the number we sold is 365,000 units, and that's gonna give us $8,577,500 per unit. Next, we're gonna want to find our variable cost of goods sold. So in order to find our variable cost of goods sold, we need to find our beginning inventory. In order to find our beginning inventory, it's going to be our variable manufacturing cost per unit times our beginning inventory. So our variable manufacturing cost per unit is $5.30 per unit times our beginning inventory, which is 90,000 units. And that's going to give us $477,000 per unit. Next, we're going to want to find our variable manufacturing costs. So in order to find our variable manufacturing costs, it's going to be our variable manufacturing costs times our units produced. So in order to find our units produced, we are going to add our sales plus our ending inventory minus our 90,000, which is our beginning inventory, and that's going to give us 308,000 units. So 308,000 units times our variable manufacturing cost, which is $5.30 per unit. That's going to give us $1,632,400. Next, we're going to want to find our cost of goods available for sale. So in order to do that, we're going to add our beginning inventory and our variable manufacturing cost. So our cost of goods available for sale is going to be $2,109,400. Next, we're gonna want to deduct our ending inventory from our cost of goods available for sale. So in order to find our ending inventory, it's gonna be our variable manufacturing cost per unit times our ending inventory. So our variable manufacturing cost per unit is $5.30 per unit times our ending inventory, which is 33,000 units. And that's going to give us 174,900 units. Next, we're going to want to find our variable cost of goods sold. So in order to find our variable cost of goods sold, it's going to be our cost of goods available for sale minus our ending inventory, which is going to be $1,934,500. So we're going to want to find our variable operating cost. So in order to find our variable operating cost, it's going to be our variable operating cost times our units sold. So our variable operating cost is $1.70 per unit times our units sold, which is 365,000 units. And that's going to give us $620,500 per unit. Once we do that, we're going to want to find our contribution margin. So in order to find our contribution margin, we're going to subtract our revenue from our variable cost of goods sold and our variable operating costs. So our revenue is $8,577,500 minus from our variable cost of goods sold, which is $1,934,500, and then minus our variable operating cost, which is $620,500. So our contribution margin is going to be $6,022,500. So once we do that, we're going to want to find our fixed manufacturing overhead costs. So our fixed manufacturing overhead cost is actually given to us on the table, and that's going to be $1,657,500. Once we do that, we're going to want to find our fixed operating cost. Our fixed operating cost is also given to us, which is $1,040,000. Once we do that, we're going to want to find our operating income. So in order to find our operating income, we're gonna subtract our contribution margin from our fixed manufacturing overhead costs and our fixed operating costs. And that's gonna give us $3,325,000. So that is how you find our variable costing. Okay, so now we want to find our absorption costing income statement. So in order to do that, we want to find our revenue first. So our revenue for absorption costing is going to be the same for our variable costing. But in case if you forgot, it's going to be our total sales times our selling price, which is going to be $8,577,500. Next, we want to find our cost of goods sold. And after that's going to be our beginning inventory. So in order to find our beginning inventory for the absorption costing, it's going to be different compared to our variable costing. First, we need to find our fixed overhead rate. So in order to find our fixed overhead rate, we are going to divide our fixed manufacturing cost from our denominator of machine hours. And we are also going to, so once we get that answer, we're going to divide that from our standard production rate. So our fixed manufacturing cost is $1,657,500. And our denominator for machine hour is 6,500 machine hours. And that's going to give us $255 of machine hours. And then we're going to divide that from our standard production rate. Which is 50 units per machine hour. So $255 of machine hours divided by 50 units of machine hours, that's going to give us $5.10. So our fixed overhead rate is $5.10. Next, we're going to want to add our fixed overhead rate with our variable manufacturing cost per unit. That's going to give us $10.40 per unit. Once we get that, we're going to want to multiply that from our beginning inventory, which is 90,000 units. And that's going to give us $936,000 per unit. So our beginning inventory is $936,000 per unit. Once we do that, we're going to want to find our variable manufacturing cost. So our variable manufacturing cost is going to be the same number as our variable costing, but in case if you forgot, in order to find that, it's going to be our number of units produced times our variable manufacturing cost. And that's going to give us $1,632,400 per unit. And after we do that, we're going to want to find our allocated fixed manufacturing cost. Okay, so in order to find our allocated fixed manufacturing cost, we need to find our budgeted fixed manufacturing cost per unit. So in order to find our budgeted fixed manufacturing cost per unit, it's going to be our budgeted fixed manufacturing cost and we're going to divide that by our budgeted production units. Okay, so our budgeted fixed manufacturing cost, that's gonna be our fixed manufacturing cost, which is $1,657,500. But now we need to find our budgeted production units. So in order to find our budgeted production units, we're gonna multiply our denominator level of machine hours and our standard production rate. So our denominator machine hour level is going to be 6,500. And we're going to multiply that by our standard production rate, which is 50 units per machine hour. And that's going to give us 325,000 units of machine hours. So this is our budgeted production unit. Now that we have that, we can now figure out what our budgeted fixed manufacturing cost per unit is. So our budgeted fixed manufacturing cost is 1,657,500 divided by our budgeted production units, which is 325,000 machine hours per unit. And that's going to give us $5.10 per machine hour unit. So now that we have that, we are going to in order to find our allocated fixed manufacturing costs, it's going to equal to our budgeted fixed manufacturing cost per unit times our actual units. So our budgeted fixed manufacturing cost is $5.10 per unit. And we're going to go ahead and multiply that from our sales, which is 365,000 units. And that's going to give us $1,861,500 per unit. So once we found out what our allocated fixed manufacturing cost is, now we want to find our cost of goods available for sale. So in order to find our cost of goods available for sale, we're going to go ahead and add our beginning inventory with our variable manufacturing costs and our allocated fixed manufacturing costs. And that's going to give us $4,429,900. Next, we want to find our ending inventory, and we're going to go ahead and deduct that from our cost of goods available for sale. So just like how we found our beginning inventory for the absorption costing, it's going to be similar to finding our ending inventory. So we know that our fixed overhead rate is $5.10. And we know that our variable manufacturing cost per unit is $5.30. So we're going to go ahead and add the two like we did for the beginning inventory. And that's going to be $10.40 per unit. So in order to find the ending inventory, we're going to go ahead and multiply our ending inventory, which is 33,000 units, from our fixed overhead and our variable overhead. And that's going to give us $343,200 per unit. So now that we found our ending inventory, we now want to find our adjustment for production volume variance. Okay, so in order to find the adjustment of production of volume variance, we're going to go ahead and subtract our fixed manufacturing costs from our allocated fixed manufacturing costs. So our fixed manufacturing cost is $1,657,500, and our allocated fixed manufacturing cost is $1,861,500. And that's going to give us $204,000. And then we also know that this is going to be unfavorable. So the reason why it's unfavorable is because our actual is greater than our budgeted cost. So once we do that, we now want to find our cost of goods sold. So in order to find our cost of goods sold, we're going to go ahead and add our cost of goods available for sale with our adjustment of production volume variance, and we're going to subtract our ending inventory. And that's going to give us $4,290,700. Once we do that, now we want to find our gross margin. So in order to find our gross margin, we're going to go ahead and subtract our revenue from our cost of goods sold. So revenue minus cost of goods sold, that's going to give us $4,286,800. Now once we do that, we want to find our variable operating cost. So in order to find our variable operating costs, that's going to be the same like our variable costing income statement earlier. But in case you forgot, it's going to be our units sold, which is 365,000 units, times our variable cost, operating cost, which is $1.70 per unit. And that gives us $620,500. Next, we want to find our fixed operating cost. So our fixed operating cost is also given to us, and that's going to be $1,040,000. And now we want to find our operating income. So in order to find our operating income, we're going to subtract the gross margin from our variable operating costs and our fixed operating costs. And our operating income is going to be $2,626,300. So that is how you do the absorption costing for the income statement. Okay, so for requirement 2, what is Tomlinson's operating income as a percentage of revenue under each costing method? And then round the percentage to the nearest 10%. So in order to find our operating income as a percent of revenues for variable costing, we are going to divide our operating income from revenue. So our operating income for variable costing, if you remember, that was going to be $3,325,000, and we're going to divide it by our revenue, which is $8,577,500. And that's going to give us 38.76% for our variable costing. Now for our absorption costing, our operating income was $2,626,300. And we're going to divide it by our revenue, which is the same as our variable costing, which is 8,577,500. And that's going to give us 30.62% for our absorption costing. And that is how you find our operating income as a percentage of revenues. Okay, so for requirement 3, explain the difference in operating income between the two methods. So our operating income using variable costing is going to be greater than our operating income using absorption costing. The main difference between variable costing and absorbed costing is the way in which fixed manufacturing costs are accounted for. So for requirement 4, which costing method would you recommend to the CFO and why? So the absorption cost costing method should be recommended as it considers all the manufacturing resources used to produce units of output.